I'm Mike Zlotnik, also known as the Big Mike. I went from being a political refugee to the United States from the former Republic of the Soviet Union called Moldova with $100 in my pocket. Now I manage over $150 million in equity, additional debt, enjoy the journey of American life. I'm a U.S. citizen, U.S. patriot, and I love real estate investing, and that's my journey. If you are looking to make money by transacting, by volume, by revenues generated from transactions, this is a wrong time to be in. Be very careful with bright and shiny objects, especially in this environment. There are still people who are selling these pipe dreams. I've seen them, and I can tell you that in this environment, you go into the wrong deal, you can lose your shirt.
Hi everyone, and welcome to another episode of the Jack Boss Show, where we talk about all things real estate, finance, and wealth and abundance. So with that, and entrepreneurship. So with that said, let's get started. My guest today is Mike Zlotnik. Mike is an immigrant to the United States, mathematician, financial genius, runs multiple funds, is the CEO of the Tempo Funding family, really, Tempo Funding Group, and runs multiple funds, is an expert in multifamily, expert in funding, expert in bridge lending, all this kind of thing. So Mike, how are you today?
Thank you very much for having me on the podcast, and I'm delighted to be here.
All right, so we're going to talk with German accent to a Moldavian accent, right?
That's right. I'm from Moldavia, Moldova, and you are from Germany. Yeah, the United States is a land of immigrants. At the end of the day, many of us have come from somewhere else in the world.
So exactly. So now, Mike, you're one of the smartest people I know, and particularly when it comes to things around economics and just market and numbers and things like that. So let's just jump right into where are we right now in the real estate market, overall dynamics, particularly when looking at both single family and multifamily and commercial?
Jack, it's a great question. And the answer to the question will be as following, right? It depends on which asset class. So most of the real estate assets go through the cycle that looks like this. You have recovery. This happened after 2008 in residential real estate. So recovery is the first phase when you come out of deep recession or recession. So you have recovery, you have economic expansion, you have hyper supply, and then you have a recession. These are the four phases. So where are we with different real estate asset classes? So residential real estate is suffering from a substantial shortage of product. So residential is not in hyper supply in a manner of speaking because inventories are very low. Theoretically, we should be there with recent interest rates. However, the environment we're dealing with is rare. We haven't seen this in many years. Interest rates were going down, 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 down. A lot of folks locked long-term interest rates at, say, 4%. Interest rates risen rapidly. They don't want to sell. The supply side of residential real estate is very limited as a result of that. So residential real estate, and it's obviously all markets are local. Depending, you're in Phoenix, I'm in New York City, experience is very different. Depending on the market, in general, we're probably at the very end of the expansion going into hyper supply. But it's not hyper supply because of many houses on the market. It's because of other factors such as high interest rates. Now, if you go look at the commercial real estate, there are various sub-buckets or subgroups. So office in general, big city office is deep in the recession. COVID dislocated that asset class. I'm not going to spend a lot of time, but it's pretty obvious what happens with big city office. 50% occupancy, they're suffering like there is no tomorrow. So office is in deep recession already. Now you go into multifamily, you go into storage. These two asset classes are sort of at the peak of expansion going into the hyper supply, but the experience is not by asset class, but really by the sponsor experience. Many sponsors have borrowed variable rate debt on value add projects, and they are suffering, the owners, the sponsors, the operators, they're suffering from rapidly risen interest rates. So it's motivated distressed owners, not necessarily that the product has been oversupplied. Right, so I'm just kind of clarifying this. Oh. Then you go into industrial. you've got some open air retail or shopping. You've got some level of hospitality. So I would put at this point hospitality towards a hyper supply for the reasons that we're about to, the expectation of recession. And generally speaking, Hospitality does get hurt during a recession. People travel less. So we are not yet in a recession, but some kind of a hypersupply. And if you're looking into the other asset classes in real estate, they're sort of moving from peak of the expansion into the hypersupply and then potentially into the recession. But you know what's the biggest risk? The biggest risk, we could spend very little time in hypersupply and go fairly quickly from an economic expansion into a recession for certain asset classes if the interest rates stay where they are. Does this make sense?
It does make sense. Let's just define a couple of terms because obviously throw a lot of at us right now. I, by the way, agree with everything you said. So when you say hypersupply, what basically that means that at some point of time, let's take single family right now, it's like right now there's really little supply because the people bought with low interest rates and now they don't want to sell because if they sell, they would have to, whatever they have to buy next has a much higher interest rate and they want to let go. What makes a market go from the expansion part that is driven by the low supply to a hypersupply market?
There are various factors, right? But one of the kind of supporting elements or supporting features of a hypersupply are typically rising interest rates. So and we've seen a rapidly risen interest rates and they're still rising. So what it typically it does, it hurts the demand. So demand becomes substantially subdued because of much high interest rates. And if the supply was normal, it'd be hypersupply relative to the demand. So the amount of inventory would be increasing. The time on the market would be increasing. There would be buyer's market. In other words, the buyers have negotiating power. In general,
so hypersupply doesn't really mean. So hypersupply doesn't necessarily mean that it's truly hypersupply. It means that there's more supply than the market absorbs at the current time. So in a world where currently there's very little supply, at some point of time, these people need to sell because of whatever they need to move, they're retiring, they're changing, they're outgoing. And when that happens, the demand is not much higher because the demand is what the demand is right now. And that demand is not going to go crazy all of a sudden. But if supply starts going up, and demand stays here, now we're in an environment where hypersupply is, even though hypersupply might really in a normal market just be normal supply, right?
Yeah, it's the name of the phase. Don't overthink of it as hypersupply. But what you describe is general conditions. Why is it called hypersupply? It's because under normal circumstances, the hypersupply actually happens. And the hypersupply can happen typically as builders build more and more of these properties. Supply is growing for whatever reasons, but the demand is weakening. And demand is weakening for two primary reasons. One is high interest rates, which is a rapid demand destruction. Number two, right, typically a recession, right? So we're all expecting a recession. Unfortunately, or maybe fortunately, we're not seeing recession because unemployment is so low. So folks are not losing jobs and they have incomes and they're still able to buy. So we're in this strange set of circumstances where if there was a normal path to recession and a normal response to the high interest rates would be in a traditional hypersupply, but we're not. We're in this bizarre cycle where the seller's not selling because they can't get the same loans that they have. So low interest rates, like you mentioned, is a phenomenal asset, especially fixed rate debt. They're keeping it. So we're sitting and observing a very strange market condition that hasn't happened in a long, long time. If you go back the last 40 years, we haven't seen this.
Yeah, I agree. So in that market condition, how are you able to plan what you invest in?
So most of what we invest in is commercial real estate. We do some hard money loans and residential, but that's not necessarily our primary business. We're looking for distressed seller situations, and we're looking for the opportunities that make sense already. So the transaction volume, as you know, in the commercial real estate has dropped 70 to 75% from last year. And residential, the transaction volume dropped too because there's no product, no inventories. But commercial, the drop is substantial in volume. We are looking for much more motivated sellers situations, not necessarily distressed asset, but distressed sellers. And we've seen this, but the volume is a lot slower. We just did a deal where we invested into two Class A shopping plazas, high quality plazas, but they were sold, open air shopping plazas to be clear, but they were sold by a distressed REIT that needs to liquidate. So they had to sell assets to raise capital from their good assets to support the bad assets. So these type of deals already happening, but they're not the volume that we would like to. So we are a lot more patient in this environment. If you are looking to make money by transacting, by volume, by revenues generated from transactions, this is a wrong time to be in. What you want to do is you want to make money asset managing your portfolio, doing a great job there, and then being very opportunistic to write fresh checks when there are motivated seller situations, when they need to sell. The other thing that we're looking for in this environment, where can we generate good cash and cash? Still pretty hard to generate good cash and cash in self-storage or multifamily. They're still trading at cap rates below interest rates. But in the open air shopping, you can pick up the deals at 7.5%, 8% cap because that's the asset class. You can still get pretty good positive leverage over the mortgage rates, and then get them with low leverage, which is the name of the game today. But these assets have pretty.
In other words, what you're saying, just to simplify it a little bit, is like when you're getting a 6% interest rate or 5.5%, 6% interest rate currently, and you're buying something that only throws off 4% per year, right, based on the purchase price, which basically is a simpler way of saying the cap rate. The cap rate is what a property throws off per year based on the purchase price. So if you're buying it at a purchase price that it only throws off 4%, but you're having to pay 5.5% interest rate, that's a hard deal to do unless you bring a lot of equity to the table. But then when you bring a lot of equity to the table, your return for the equity is very, very low. What you're saying is that in certain asset classes like retail, you can pick up properties. You still get the loan at 5.5%, but or whatever it is, between 5 and 6%, depending on what the Fed does. And but the product throws off in 8 or 9%, like throws off 8 or 9%. So basically, your return or your cash flow is higher than what you need to pay the bank. So you can actually get a higher leverage on the product, and your equity that you're putting in gets a much higher return.
Yeah, basically exactly that. So in the multifamily and self-storage, industrial some level, that is known as a negative spread. What you just mentioned, when you're buying at 4, 4.5, 5 cap, and you're paying 6% mortgage rate, you have a negative 100 basis points, 200 basis point spread. In the shopping plaza, it's one of the few asset classes you can actually pick up a pretty decent positive spread. And that's the spread between what you earn on unlevered cash and cash, 7.5%, 8%, 9%, and then the debt service, which you borrowed today, let's just say 6.5. So the concept is that most investors want to invest today with strong downside protection. We look at these type of deals. Where do we have downside protection? Downside protection is not in the negative leverage deal like multifamily. I'm not saying multifamily is bad. You could still get a great deal if you have substantial value at and you buy it at the right price. But if you're trying to take less risk and still have good downside protection, this is where we like open air shopping. So on that particular deal that I mentioned, and that's the only large deal that we did this year. Last year we did significantly more business, but this year we only did one. We basically locked in fixed rate interest for 5 years with no prepayment penalty. We bought it, shopping plazas with one of them 75% occupancy and 25% vacancy. And that's the upside. You can lease up a space and you can get good positive cash on the as-is basis and still have 25% to lease up. That's a lot of upside. Yeah. Also, shopping plazas have some really interesting strategies that you could sell out parcels as a standalone transaction once it's entitled, and you can sell them at a lower cap rate at a higher price and return cash to investors. So some of these strategies that we utilize a little bit more defensive in nature today, that we are looking where we can get cash, but we're opportunistic. Listen, if we found a great deal from a motivated seller, and even if there was no cash flow in multifamily, and we can get the right price for it, sure, we would still consider doing it.
Yeah, no, absolutely. That's a great lesson, a great statement, great kind of few minutes right now of really looking at different market cycles in different ways. Like our audience, like if there a lot of our audience is people wanting to get into real estate, or perhaps even doing already land flipping, what we teach, or just like trying to get knowledge about different asset classes. And I think you very brilliantly explained, first of all, that the market is not the market, but the market is number one, local, number two, different for asset class, and number two, like how in a market that we are today, you're still able to make money by switching strategies and being more defensive and focusing on asset classes that have upside and that actually, more than anything, provide really good cash on cash. So that's brilliant. So with that said, let's talk about your company a little bit. Let's talk about you a little bit. So obviously you came to the United States in 89, you think? 1989?
Yeah, it was still the Soviet Union. It was that
wow.
long ago.
Yeah. I remember going to Russia in 1991 as part of a field trip, kind of like with an orchestra I played in Germany with, and it was interesting. There was one McDonald's open in Moscow, and that's about it. And it was an experience to remember for sure. But so you came to the United States '89. You have a bachelor's in now you got a bachelor's in mathematics. So you're really a numbers guy. And then over to let's fast forward. You became part of Tempo Financing or Tempo Investment, and so tell us what your company does. Most importantly, you talked about a little bit already, but tell us a little bit about you and about your company in more detail.
So I'll give you a really short journey. So I came, like in the James Bond movie, they call it From Russia with Love, but I didn't come from Russia. I came from Moldova. And now it's not very popular with what Putin is doing in Ukraine. So all that aside, I came in '89. I went to school, upstate New York, have a degree in mathematics. I studied also computer science. I spent many years, almost 15 years in technology field, working various technology jobs. But my passion has always been real estate. I discovered real estate in 2000 when I bought my first apartment in New York City, and then I kind of continued to be a passive investor for 9 years. 2009, I essentially retired from my technology career. After some successful exits, I was done. I was tired. I was burnt out, and I wanted to go real estate full time. So at that point, I joined Tempo Funding LLC. We've done a good amount of hard money lending. We financed a lot of fix and flip projects. But at the end of the day, all that financing generates current income. It doesn't build wealth. So we discovered through personal investing first. And over the years, I started to raise capital through our funds and invest in commercial real estate projects that do build wealth for our investors and promote for us on these projects. So we started to build family of funds. Tempo family of funds. We have Tempo Income Fund. We have a Tempo Growth Fund, Tempo Growth Fund 2. We have Tempo Opportunity Fund. The funds, the way they work is they're diversified investment vehicles. They spread the risk among many investments across many strategies in many regions around the country with different operators. Why it's important? Well, you don't know what's going to be a home run and what's going to be a strikeout. So real basic mechanics of diversified funds, they reduce risk, they increase predictability, and they reduce volatility. We love this. I've always loved this strategy. We've built it on a fund level, and we launched Income Fund to focus on income focus strategies, and a Growth Fund or Growth Fund 2 to focus on growth strategies, and Opportunity Fund is sort of in between. We've done that. On top of that, we've done one-off syndications where we partner with top operators. Certainly love multifamily. You do multifamily. I love multifamily as a value-add strategy. You invested into some of our deals.
Yes, I have.
So, I appreciate that. And we continue to focus in this environment on really strong operators where they have great footprint in a given market. What I'm mostly concerned about is if you're in Phoenix and you're buying a deal in Atlanta. What I prefer, you're in Phoenix, I want you to buy a deal in Phoenix. Have your own warehouse with materials and have your own crews and leasing and management. You need to have stronger property management, which has become a big issue in this environment. I see this again and again, where folks come in and they have an asset 1,000 miles away. It's very difficult to manage. Relying on third-party property management has gotten way harder in this environment. So back to what we do. We run funds, and we also have one-off deals that all focused on working with top-of-the-line operators who go deeper. We want to find great, always starts with people, know, like, and trust, understand their strategy, and then picking the right deals and then negotiating the right terms. That's what we do day in and day out. So investors, when they write a check into one of our funds, They basically spread the risk among the fund portfolio. And then as fund managers, we deploy the capital into many assets. And we, in certain things are income focused. I'll give you an example. On the income front, you do land. You are one of the most prominent land experts and educators in the country how to buy land. As you know, we work with a few other guys who do land, the discount lots guys, right? And that whole strategy is they buy recreational land and they sell it on seller financing, right? And we finance them. And we charge them high interest rate, and now investors get great returns through that strategy. And it works because they're going to buy a lot for $4,000, sell it for 25 on a 6-year payment plan. You know how it works. It's a wonderful strategy. It works. If you can do that, you can get great yield. And we do it on a fund level. Tempo Income Fund has a strategy. Part of its offering is we call them Class D units, which basically generate high yield by investing in the strategy.
That's exactly right. So yeah, so you guys play with some of the big players in the space and actually give them, in essence, lines of credit or finance their lots, different strategies, not necessarily lines of credit. So they can basically buy these properties, cash out in volume, and then pay you guys back over the term, over certain terms on these loans. And even if you charge them 18 or 20% interest or whatever you charge them, or higher than that, I don't know, it is on the $4,000 that they buy a property on, not on the 25 that they sell it. So it's really it still becomes a no-brainer for them and becomes a great liquid source. Now, however, the minimum kind of agreement that you do with somebody when you invest in something, you don't buy. You're like, I just want to make sure you don't get flooded by our students who say like, hey, Mike, can you fund my $4,000 lot? No, you only work with basically companies that do hundreds and hundreds of deals a year, because you have cost in the management and the overseeing and all the paperwork that comes in there. So typically when you work with something, when you work on a loan, also you do transactional funding. You don't do transactional funding for a $10,000 lot, right? What kind of like are the minimum numbers that you work with in terms of like minimum volume that somebody needs to do in terms of dollar figures? Like what's the minimum if somebody has a house flip or a house short sale or something they want to do? What's kind of like the minimum loan? I know we had that conversation offline, so I just want to make sure you put that out there.
Yeah, I appreciate that. And thank you for that clarification. Let me answer the question. Instead of giving a specific amount, let me take a step back. So number one, we're absolutely not going to finance $4,000 or $5,000 lots at whatever the interest rate. Just for full disclosure, we charge these guys between 16 to 18% rate, depending on when we advance the money. And we pay our investors between 12 to 15, and then the arbitrage, the delta goes to actually the fund, and we get paid to the fund waterfall. So yes, and it's a large $25 million line, and we've advanced to them like $12 million. So we definitely want to work with fewer, bigger players. On the transactional funding front, we used to do a lot of them, and we do very little right now because the transaction volume for these A, B, B, C flips is pretty rare. At least we want a proper structure. So most of them that we done kind of lower end of the spectrum, 100K flip, transactional funding flip, we most of the times don't want to dip below 100K. And even 100K, we need a strong referral. So if somebody wants to work with us, reaching out to us and say a 100K flip without referral from you is not what we want to do. Honestly, we only take new business on a strong referral from somebody who we know, like, and trust. So if you have a student and you've known them and they do good business and you're comfortable that they are capable, knowledgeable, and it's going to be a repeatable, consistent business and easy for us, we'll consider doing this. What I don't want to do is one-off deal here and there, and we just don't need the business. I mean this with all due love, respect, and admiration for wonderful students.
I understand. And actually, go ahead. I want to then ask a different question. Go ahead.
Yeah, so we generally don't do really small loans. Although we've done transactional funding flips, you're going to laugh, years ago. I mean, this is years ago. So people didn't have cash for like a $20,000 flip. So we've done them. When we were doing the business, we had a relationship. But the amount of work you have to do to work with the title company or escrow company, it's not worth our time. At this point, we're so much bigger. So we'll do it as an accommodation on the relationship. And honestly, they would need to reach out to you, Jack, And then if you give them a good referral, we'll consider working with them. We just don't.
Yeah, and
how should
guys,
I
if
put it?
you want to do that, do that. I mean, I kind of know what Mike and I have worked on different things. We have invested in some of his projects, and we have ran some of our projects by him and so on. So I think I have a good understanding of what you do and what you don't do. So make sure that if somebody listens to this and has a deal and it doesn't have the relationship, you reach out to us, you reach out to our customer service, ask him to forward it to me, and then I'll look at it. I take a quick glance at it and give you some feedback on it, on whether or not that's something is worth forwarding and moving over to you guys. Because I mean, you guys, like, what is the largest largest raise that you have done for one single project outside of a fund?
So we've done. So I'll give you one of the largest deals we've done. It was $170 million purchase, $171 million in Indianapolis, 1,261 doors, called Lake Castleton Apartments. The total equity raise was right around $50 million. And it was actually structured with the preferred and common equity. Preferred was around 30, common was around 20. And we raised 14.2 million out of 20. And then the rest was the sponsor. So probably as a standalone deal, this was one of the largest. We did another deal last year where we raised 16 million on a similar deal, just a little different. We raised 16 million into a single deal. But in general, those are probably upper range of the capital raising that we've done in that $14-16 million range.
Yeah, one of them we actually invested in. And that's actually some of the cool things you guys do. I'll get to that in a second, but with some of the tax things that you guys do, some tax advantaged investment. But well, let's get into that in a second. One thing I hear you say again and again and again, and I do want to talk into it, because there are you here sitting with a math background, and it's numbers and it's mathematics and it's finance and it's things. Yet one word that you keep saying again and again is with people that we like, know, and trust. People like, know, and trust. It starts with a relationship, starts with the people. I want everyone to hear the importance of that. Can you expand on that a little bit? Why is this so important?
Because life is short. We don't have, unfortunately, we don't have time to spend time working with amateurs, new folks, and also trust takes a long time to build. So I don't know how to put it. We've seen idiots, we've seen shysters, we've seen anything you want to call it, right? So the older you get, I'm not that old, but I think of myself as a conservative investor. So the older I get, the less new things I want to try. I want to stick with the people who we've developed these relationships, and it takes years to develop. And if you spend enough time in this industry and you build strong relationships, they continue to pay for years to come. It takes a long time to develop and nurture these relationships. So not that if you're younger, you're starting, you have high energy, high desire to be successful. That's wonderful. But I'm kind of an old dog. At this point, I just don't want to take the risk. And when people invest with us, I want less risk for our investors. And it's not a perfect world. There's risk in everything. Nonetheless, at least elimination of the people's risk is something that we're trying to do. And we've seen situations where we've tried with some new folks over the last however many years, and they've not done well. We've had many great projects and a few, let's just call them strikeouts. And what do you learn from these strikeouts? Is typically some of the things that I mentioned, right? You try new relationship until one of the big challenges in real estate, it's slow to move. It takes 4 or 5 years to go full life cycle. Until you go through a couple of years, you don't really know who is good, who is not. So the only alternative to taking those 2, 3, 4 years and multiple deals is you're relying on referrals. And hopefully the people who is giving you the referral, or the person who's giving you the referral, you trust them and they're a good judge of character and they have good experience. But at the end of the day, this is the biggest challenge in real estate. If you wait for full life cycle, it's a long time. At the same time, we still need to do business. So what we try to do is just go deeper with the relationships we have, and we understand what else you got, what else is coming up. For them, it's also easier to work with us because instead of looking for new sources of money, it's not always about the cheapest money if you're raising capital. And it's not always about the biggest return when you invest in capital, right? You're all looking for a ease of relationship, good risk-adjusted return, but at the same time, you're looking for many factors that are just how simple and easy is your business. And the reason I mention this is that could we grow a business financing these 100K loans? We could do a lot more of it. I just don't want the business. What I want, fewer, bigger transactions with great operators, but don't get too big because we still need to diversify. So it's kind of a balancing act, knowing where is your kind of sweet spot, what zone. So we're comfortable with deals probably anywhere from 5 to 15 million, maybe $20 million raise. At the same time, I don't want to have deals that are too small either. Although we've seen some really bigger returns on smaller deals, but we're not gigantic either. Please understand, we don't.
No, I fully understand what you're saying, but then I wanted you to say those things so that the audience really can hear that even in the finance world, or particularly in the finance world, actually, I want to say, money is not everything. Like so when and the same applies for deals that you look at. I mean, over the last few years, when there's deals everywhere and everyone promised 30% returns or whatever it is, like we always made a case when we presented our pro formas and our things to basically say, no, we don't. The people would compare us and say like, well, I'd rather put my money with this guy because he's promising me 25%. It's like, yeah, if I change 3 of my assumptions, I can promise you 30%. Right? But I'm not doing that because the likelihood of me hitting those 3 numbers is very, very low. So I can assume anything I want and promise anything I want. But the real judgment at the end of the day is, can I deliver what I promise? And I rather promise less and accomplish it than promise a whole lot and then be a failure and so on. And so in business, a lot, in any kind of business, it's a people's business first. So you need to work with the people that you want to work with the people. You have to work with the people that actually don't just promise something and then don't deliver. You want to work with the people that are solid, the people that deliver on their promises, the people that don't overpromise, the people that communicate well. And that is something that, believe it or not, is not that often to be found out there. There's a lot of fly-by-night kind of people that learned how to do something and then try it out one time. And I love you keep saying, even though you have a math brain, a math degree, worked in finance, worked in software, you keep coming back to the people, keep coming back to the referrals, keep coming back to I rather make less on a deal, but no, it's a deal that we all sleep well with than a deal that promises high return, but it's a nightmare to manage.
Yeah, Jack, I have a term for this. It's called bright and shiny objects. And if you have a bright and shiny object syndrome, you're probably going to lose money. At the end of the day, I've seen too many people who have invested in these pretty looking, beautiful pro forma, overhyped deals, and many of them will drastically underperform, and some will be complete money losers. So I'm in agreement with you 100% that selecting higher quality operators on more conservative underwritten deals is the name of the game.
Yeah.
So that's
like Warren Buffett's. It's Warren Buffett's rule. Like rule number 1, don't lose money. Rule number 2, don't forget rule number 1. It's like if you just don't lose money and it doesn't matter if you make 8% or 12 or 15. I mean, of course it matters, but if you compare that to somebody who loses money, if you lose money, you got to spend the next couple of years just recovering, just getting back to ground zero to where you were a couple of years before, versus even if you make a little bit less return, you're still ahead of the game than you were before.
Yeah, so I want to comment on this. We've seen this too many times in both through successes and failures. This is why we run these broadly diversified funds, because it's exactly the philosophy. I would rather deliver our investors predictable, again, full disclaimer, I mean, read PPM numbers, but let's just say 10 to 13%, depending on the fund. We have some higher return targets, some even more conservative. But the point is, if you get conservative returns that are much more predictable, you're much better off than hitting a few of these 20% plus. We've had deals that hit 140% IRR, right? But that's not the expectation. That's a deviation from the norm. In this environment, steady Eddie, boring wins. And be very careful with bright and shiny objects, especially in this environment. There are still people who are selling these pipe dreams with they lock these contracts with the deals that are completely not well bought. They are still doing them I've seen them, and I can tell you that in this environment, you go into the wrong deal, you could lose your shirt, and you have to be careful. And what's important today, greater reserves, not lower reserves. A few years ago, people were underwriting for perfection. They were underwriting just enough cash, assuming interest rates were not going to go up, assuming execution was going to be perfect. And you go through all these aggressive conditions. And if any one of them or two goes wrong, you're already underperforming. If a bunch of them go wrong, you can lose all the money. The reverse is true. Now we're going to, the pendulum is going to swing all the way the other way, where most of the deals that's going to get done, at least the ones we're going to invest in, are going to be much more conservative, lower leverage, better sponsors, low level of risk. And this is the way to think about this. When the economy is on a downturn, you started the conversation where we are in the cycle. The cycle is a down cycle. You can make money on a down cycle. You just got to be more careful and more conservative. When everything is going up, the tide that pushes all the boats up, that's wonderful. But we're not at this time of the market. We are at the tide that's kind of receding, and yet you have to be really careful investing in this environment. That's kind of what I'm thinking.
No, I agree with you. So I want to just cover one extra last piece, and that is how you sometimes structured deals, particularly in the multifamily space. Now we're going into the little bit more advanced ways of structuring these deals, because when you typically see a multifamily space, you see a PPM, you can invest money in it, you get perhaps a preferred return, and then you get a percentage of the profits at the back end. That's like the simplest way. When you structure some of these deals, particularly at the one that with the $160 or $180 million purchase price in Indiana, you had built in a couple of different, or the sponsor, or you guys negotiated built in a couple of different kind of investor spots to get in. So you had invested, you had one spot, and you can use the proper terminology for it. I'm just going to use simple English here. That basically one spot where the investors would get a higher cash flow percentage, but therefore they would get little or no of the depreciation that came with the deal. And another investor spot that would get very little or sometimes even no cash flow, but would get a much larger portion of the depreciation in the back end. So why are these different things structured, and who are they for? Well, some of them, there's this concept of being the real estate professional, that you can use the write-offs from real estate and apply it against your active income. And there are certain investors that are not real estate professionals, so they can't use the depreciation beyond covering kind of like the cash flow. But then there's others that, like, for example, us, like you, that we're real estate professionals, we do real estate all day long, that we can use all the depreciation against other income that we have. So, for example, we invested in that second kind of tier where our cash flow so far has been zero, but our depreciation has literally saved us huge amounts of taxes, because it almost like wiped out our tax liability for last year. So with that said, can you explain that a little bit more and probably more industry terms?
So full disclosure, again, not CPA, don't play one on TV, don't give tax advice, consult with your CPA professional.
Neither do I.
Always. But we've structured these deals with a help and support from CPAs and tax attorneys. And let me kind of explain the primary bucket. So most of these commercial real estate deals, multifamily deals, they're acquired with typically first lien mortgage, and then there's an equity component. So you can structure all of it with just common equity, which is a classic case, or you can do what we've done, calling the advanced structure. So advanced structure has both preferred equity and common equity. So preferred equity, as you pointed out in the example, and I'm trying to remember, was it Michigan 2 or Oak Park, one of these deals that we did last year, and I think one of those deals. So there's a preferred equity component and common. Imagine this, I'm just going to go high level. So preferred equity investors, they have seniority of their preferred return, and that basically moves all the cash flow from the deal to them. So they receive a higher yield. They also have higher safety of the principal, because they get paid ahead of the common equity. Then you go to the common equity, so preferred and common. The common equity also has a pref, but they get paid their pref after the preferred equity get their pref. And then they get the return of capital also after the preferred equity. So they're taking on more risk, but also they take all the depreciation benefits. So the deal was structured such that preferred equity, which works really well for IRA money, they can't use depreciation. There's no benefit for them. So folks who need cash flow, they don't care about depreciation. They want higher safety. They all go in the preferred. And folks who need high tax depreciation benefits, they go into common. Common take on more risk. It is a requirement that you have to be comfortable with a higher level of risk because then you're in that position. But you get a ton of benefits. On that deal, investors received, off the top of my head, 1.8 to 1.9x for every dollar they invested in depreciation. And the best way to think
you
about
invest $100,000, you get $180,000 worth of depreciation. Which, if you're the top tax rate, if you add all of taxes and it's like, say, 37%, let's round it up to 40%. You invest $100,000, you get $180,000 write-off against your taxes. So you just shielded $180,000 of income from taxes, which means your actual tax savings in that case is about $80,000. So you invested 100, but right away it gives you an $80,000 worth of saving. But again, it comes at a higher risk. It comes at a risk that if that property doesn't do that well, if it doesn't, then only the preferred equity gets paid back, and you might end up not getting much back. Right? That's something you got to be aware of, and that's actually a requirement by the IRS. They can't just say, "Hey, you can't just get all the depreciation without giving up something else in return." So,
let me give you a little more color on this.
Yeah.
So, not only that, the IRS has an important provision. Just to be clear, there needs to be capital deficit restoration provision, which simply means you put in 100, you got $180,000 depreciation. So your capital account is now negative 80,000. You started with positive 100 minus 180 of depreciation that you got. Now your capital account balance is negative 80,000. What IRS wants to do in order for you to be able to take that is called capital account restoration provision, which means if it needs to be a capital call, the common equity people need to bring that capital to restore in case the project needs it. This is a technical requirement, but that's what makes these deals possible, where they can go into negative account on a capital account balance. Yes, and they take a higher risk. But what's important is general, when you invest in these projects, you should not be investing purely for depreciation benefits. It should be a sound investment with a strong operator, strong strategy. It so happens that the tax benefits are great, but I just want to make sure that the tax tail of the tax tail of a wealth dog doesn't kind of mess up the plan. The plan is still long-term investment, but the fact that you get these great tax benefits help for those folks who are real estate professionals who can use those depreciation benefits to offset income from other sources.
Yeah, no, 100%. I mean, when we saw this deal or any deal that in that structure we look at, and we have passed on many of them that were offered to us in the kind by other people that we mutually know. We looked at them, and not all of them or most of them, we're like, no, we're not comfortable with the deal. We're not comfortable with the operator. We're not comfortable with the numbers. We're not comfortable with the model. And as a result, even though the tax benefits looks really beneficial here, it's not worth, because you're still investing 100 grand and you want that 100 grand to come back plus some return at the end of the day. And just you look at the tax benefit as a bonus. And in this case, since you're also subordinated to the other equity in there to some degree, actually the quality of the operator, the quality deal is even more important, because you need to make sure that you only want to invest in the deals where you can say, yeah, this all makes 100% sense. The likelihood of me losing my money is minimal. So therefore, I'm comfortable going into almost like a secondary position behind the pref equity. So, but what I wanted to say with all of that is, like, I want to simplify it quickly, is when you hear that when you invest in multifamily and other kind of things, and you talk about the depreciation factor, just the normal depreciation that you're being offered in most deals, there is other ways to structure the deal. And the way that you might just structure that, explained it, there's deals out there that where some of the investors get the higher security, the higher cash flow, and others get lower security, are put behind those in seniority, but they get all the depreciation. So from a tax point of view, there's some really interesting and advantageous ways that you can invest in some of these strategies and shield a good part, and in some cases even all of your income, depending on how much you invest and of course how much your income is. Now, that fact that not everyone gets the same, but that within the equity structure there's different tiers and can be put in place, that is something that not everyone knows out there. Like, to you, this is normal. To me, yes, this is normal. We've heard that, but not everyone knows that even exists. So when you're looking at syndications out there, ask them that question. Ask the syndicator that question. The answer might be no, because the syndicators are like, in our deals, we don't do that. We just simply spread it around to investors. But perhaps down the road, we will. And when we will, we want to make sure that our audience is also informed about it.
Yeah, I appreciate, Jack, that color. And in fact, our Tempo Grow Fund too is structured with preferred and common equity units. We did this even on the fund level because we like the idea. But there are different strokes for different folks. This is not for every deal. This is for some deals where you have a lot of investors who need a lot of depreciations, and you also have a lot of investors who want higher safety. So if you distinctly know the level of comfort of and the demand for different product, then you can structure the deal. This is part of what I do is a little bit of this financial engineering, but it's being built for demand. So what's really amazing and fascinating, how did I come up with this idea? I didn't invent the wheel. It's been around for a long time. When we did our first growth fund, Tempo Growth Fund, the original one, we had plenty of investors who wrote a check in the fund and say, I know you got a bunch of IRA investors. They don't need depreciation. Can you just give me that depreciation? I said, I would love to. When you talk to CPA, you said you can't arbitrarily move it. It's not something you can just move around. So you have to structure the deal properly. If you have enough investors who want the high risk and high depreciation benefits. So I know we're going around the circles, but at the end of the day, deal structure is a function of knowing your investors and your ecosystem. So we wouldn't do this just because every investor wants it. We had enough in each of these buckets. It's very possible. So in the next deal, we will not have a structure. We'll have a normal structure because this is an advanced structure. It doesn't work for everyone and every deal. Some deals it works, some deals it doesn't. The other thing that's happening, this is a little bit of a negative development in industry. This is not, necessarily bad. It's been around. The depreciation is phasing out. This yes. 2017. So we were up to 100% bonus depreciation all the way through last year. Now it's 80%. Next year it's going to be 60%. The result of this, that these tax benefits are phasing out, and it's going to be harder and harder to put together these outside depreciation deals. So if we don't have enough demand, we'll just take a step back and just do normal depreciation. So yeah,
and plus there's not many deals that qualify right now anyway. So this year we haven't done. You have done one. We have done zero this year because just nothing qualifies. So we're just patiently looking, and if it then takes us into next year, it's only 60%, and at that point it gets harder and harder to do that. I see that. Well, with that said, Mike, how do people get a hold of you if they want to potentially invest with you, if they want to just learn more about like your funds and so on?
Jack, it's really easy. It's kind of cheesy, but it's easy, right? So Big Mike, right? People know I'm known as the Big Mike in the CG Mastermind and many other communities. People call me Big Mike. I do run a podcast called Big Mike Fund Podcast. I couldn't come up with more creative name. Easy to remember.
Mine is called Jack Bosch.
You have your first and last name. With me, it's just simple. It's bigmikefund.com. And if you misspell it, if you forget the D at the end, bigmikefund.com. I promise it's not a kinky site.
Okay, sounds good. So bigmikefund.com, there you can find out more. Check out his podcast. Again, he's called Big Mike. Why? Because how tall are you? You're like,
I'm 6'4", a little bit on the heavy side. So
yeah. Any kind of last words you want to give out to the listener community here? Any kind of words of wisdom?
Real basic stuff, kind of back to the principles, right? All real estate is local. So if you want to invest into something you understand, and you're in Phoenix, work with Jack in Phoenix. If you want to invest 1,000 miles away, get to know, like, and trust people and make sure they understand what they're doing. At the end of the day, it is an old world, and we continue to operate like this. It's kind of a funny. People ask us, because we both are capital raisers and capital investors. So we're always wearing two hats. And I can tell you, don't invest with me if you don't get to know, like, and trust me. In the same way, I'm not gonna ever write you a check until that other thing happens. I know it's an old wisdom, but build
100%
relationships over time. And working on a new book. If you want to reach out, there will be a new book coming out. I don't yet have the exact title, but it's going to be all about real estate, all about advanced strategies, and some are basic stuff. So appreciate the kind invitation to be on your podcast.
Thank you very much. I will definitely read that book. So with that said, guys, as always, give us a 5-star review, hit that subscribe button, hit that, forward it, share it with you, wherever you listen to it, watch this, and make sure you follow us, share it with the world. There's many more podcasts to come. And as that said, thank you, Mike, and thank you, everyone. Have a great day.